Hey, what's going on, ADPI Nation? Kevin Brenner here, host of the Active Duty Passive Income Podcast. And you're in for a treat today because we have the one and only Jay Scott in our virtual studio. If you don't know who Jay Scott is, I don't know, read a book. Maybe read this book or any of the books that's behind him. And if you're watching on YouTube right now, you can see that. But this book got me through some stuff. The book on estimating rehab costs. I believe there's another version.
I think there's been one or two releases since then. My wife actually designed that white cover. Luckily we've gotten some redesigns in the last 10 years. So that's nice.
Yeah, this is the original. I'm going to bring it down to ADPI, kind of be like, Jay, can you sign this for me? No, but for real, man, because I was faced with that situation. Many of our listeners know my story, but had a quadplex with the VA loan. And 4 or 5 weeks after closing, I got orders to Washington, D.C., and I had to do 4 remote rehabs from 1,000 miles away. And that was a little bit difficult because I didn't know anything. So I was like, I got this book and I was like, oh, that's how much this thing should cost. Because you get these estimates back from these contractors and it's like, if you don't, they'll just take you for what you have if
Absolutely.
You don't know how to negotiate. So that, I don't know, that book, that $19 purchase, however much the book cost,
I appreciate that.
Probably saved me a couple thousand. Trust me, I appreciate it more. And I recently sold that asset for a $400,000 gain. So, that's what it's all about, right? That's why we invest, right? Beyond that, we're going to talk today. If you're listening to this podcast, you want to know what we're going to talk about. We're going to talk about Jay, a little bit of your background and how you kind of started with flipping houses and why. And then we're going to talk about your transition to multifamily, like large commercial multifamily, and what that was all about. We're going to talk a little bit about the economy. I mean, things are pretty interesting these days. And I always, when I have prolific investors on like yourself, I always like to get your outlook on the economy and the commercial space, where it's headed, where you think it's going, and what you're doing to position yourself. And maybe some of our listeners can adopt those ideas. And of course, we're going to finish up this episode with a huge announcement, and I'm going to tell you at the end. So just listen, people. And I suppose you could fast forward, but don't, because it's going to be really juicy. All right, Jay, jumping into this. I first heard of you on Bigger Pockets. That's where I kind of learned real estate investing back in the day. And I think I may have heard you on their podcast or something. Brandon was interviewing you. But talk to me about how you got started in real estate investing and why house flipping, because a lot of people think that's
so my story actually is not that interesting, and I'd like to say that my career in real estate was brilliantly planned out, but the exact opposite is true. Basically, I kind of fell into everything I've done in real estate for the past 15 years. So I started out as an engineer, a business guy. I worked in the tech industry. I was in Northern California, Silicon Valley for a long time. 2008 rolls around. My girlfriend, to be wife at the time, and I got engaged and decided the whole tech thing, working 80 hours a week, traveling 3.5 weeks a month, just wasn't for us. There was just no way we were going to be able to start a family, raise kids, and kind of be able to put lifestyle first if we were living in that kind of that atmosphere. So when we got engaged, we literally decided together within about 10 minutes, let's quit our jobs. Let's figure something else out. Let's focus on something that will allow us to put lifestyle first, allow us to put family first, and just figure it out. So 6 months later, as we're getting closer to the wedding, we quit our jobs. We moved back to the East Coast. And summer of 2008, we're sitting around talking about what should we be doing next? What is that thing? Are we going to start a business? Are we going to do consulting? Are we going to buy a franchise? We had talked a little bit about investing in real estate, but passively, not actively. And while we're having these discussions, one day we're sitting on the couch and a house flipping show pops up on TV. And my wife, it was HGTV in 2008. I think that's all there was.
Look at that. They did. Look at that, honey.
They
did. It in 30 minutes.
They did. And they made lots of money with essentially no effort. And so my wife is watching one of these shows and says, hey, let's flip a house. And I thought she was kidding. I had no real estate experience at that point. We were in our mid 30s. We had just bought our first house, which was the house we were living in. I could barely change a light bulb. So there was no reason to believe that we were qualified to flip a house. But when the woman you're about to marry says, let's flip a house 2 months before the wedding, I'm not going to say no. Not going to give her any excuse to back out. So I said, okay, let's figure it out. And so summer of 2008, I hopped on Bigger Pockets. I started reading. I think I picked up a couple of books. I scoured the internet and we started looking for houses. We ultimately bought 2 houses in August of 2008 to flip because we couldn't figure out which one was a better deal. Don't ask me why we bought 2.
And
this was Atlanta, Georgia.
what
This was
because you're East Coast now. Okay, so you're in Atlanta. Okay, so you're in Atlanta in 2008, and I know it's like so easy to go and put our Monday morning quarterback on and say like, oh, well, I would have done that too. But you don't know because think about it, 2008, like the market is tanking. Like you don't even know what is going to happen. So like from your perspective, you're sitting back in 2008, you're like, I don't know.
Yeah, the crazy thing is, had I been more knowledgeable, if I had the knowledge then that I have today, zero chance we would have started flipping when we did.
Oh yeah.
No, I probably would have stayed out of real estate altogether. I mean, at that point, the market was down 10, 15%, and it looked like there was a long way to go. But at that point, I didn't know enough to say, hey, maybe I should be more cautious. Maybe we shouldn't be doing this. We just jumped in without thinking about it. So yeah, maybe I would have bought multifamily. Maybe I would have done something different. But most likely, if I had the same knowledge I had today, with the experience I had back then, I probably wouldn't have done anything. So I guess it was good that I knew so very little at that point. So we jumped in, we bought 2 houses. The first one we bought ended up making every mistake in the book. Luckily, we bought that second one because had we not bought the second one at the same time, we probably never would have bought a second one the way the first one went. But the second one went better, and the third one went better, and the fifth, and the 10th, and the 50th, and we just kept going. And so that's kind of how we got into real estate and flipping houses. It wasn't a grand plan that we had. It wasn't well thought out. It wasn't strategic. It wasn't let's analyze the markets and figure out the right location and the right strategy. It really was. We happened to be in Atlanta with nothing else to do, and my wife suggested we flip a house, and so we did.
Yeah, and it's crazy, because looking back and you talk to these house flippers and it's like, and you think that everyone's got it all mapped out, like you said. But the truth of the matter is sometimes when you just have the time and, you were coming out of the tech industry, presumably making, pretty good money. So you had some lucrative savings. So it was like, okay, well, I'm not working that now. I've said no to the 80 hours a week and 75% travel per month because that's not conducive to a family. However, we're moving back to the East Coast and we want to try something. I like the idea of just like kind of jumping into something. Personally, I wish you would have educated yourself more, but also like I respect it because at some point, that's what life's about. It's about taking risks. And what I tell our listeners on the show is, and anyone who will sit long enough to listen to me, is never be afraid to bet on yourself.
Yep.
Like everything is figure outable. And if you never bet on yourself, then you'll never really grow,
yep.
Because you'll always be in that comfort zone. And I think you and your fiance at the time, now wife, you guys seem to put all the chips in the middle of the table.
Well, here's the crazy thing. I mean, we look back now, and in today's environment, it would be nuts for us not to do more research, not to have attended more real estate meetups and listened to more podcasts and read more books. But this was 2008. There were no podcasts back then. There were some books, but the books that were out there are not like the books that are out there today. Bigger Pockets was a couple thousand members, and not anybody with a ton of flipping experience. The real estate meetups, there was nobody showing up. This was 2008. The crash had just started, and anybody that was flipping houses in 2005, 6, and 7 was probably licking their wounds and sitting on the sidelines. So I would go to these real estate events, and there'd be 6 of us there. And this is Atlanta, where basically if you had gone a year earlier, there would have been 400 people. So there weren't people to learn from. There weren't a lot of resources. Certainly I could have done a little bit more research, but it was a different time. And so I'm not sure, given the timing and given just the pre-technology information age that we're in now, I'm not sure it would have been easy for me to gain a whole lot of knowledge prior to jumping in. So I don't know if that's good or bad. In retrospect, it was good because it gave us the confidence to jump. We didn't know any better not to. But certainly there was a lot more risk than there would be now, when you could literally spend 6 or 12 months educating yourself before making that first move.
Yeah, 100%. And, we always talk about the ADPI triad, like learn, network, take action. It's an iterative process. It's constantly happening. You're constantly learning, constantly networking, constantly taking action. So, but at some point you're going to have to get out of that analysis paralysis, and you're going to have to jump in and bet on yourself and take that risk for better or for worse. Regardless, it's going to be a learning.
Absolutely.
It's going to be a learning experience. And I think a lot of people kind of lose that element of like, well, I don't want this to happen, and I don't want this to happen. And you come up with a million reasons not to do something, when ultimately you just, at some point when you've taken in all that knowledge, you just gotta jump into it and get uncomfortable and figure it out. And I commend you for that. Yep. So you're flipping houses, Jay, and you said you got up to 50, like at some point it has to become, I don't want to say automatic, but
yeah, for us, that was part of the reason we were successful. I'm not a real estate guy. Again, I can still barely change a light bulb. Our toilet in the next room is running right now, and I can't figure out how to fix it. I have to call a plumber to fix a running toilet in the next room. I mean, it's crazy, but I still have very few skills. I'm not the guy you want managing contractors or swinging a hammer. But what my wife and I were both very good at was the business side of the business. We were very good at putting together a team of people who were a lot smarter than we were, a lot more talented than we were, and managing them. And then focusing on the systems and processes that would allow us to scale the business in a way that was truly efficient, so that we could increase our profit margins, so that we can decrease the amount of time that we're holding properties. And so we really focused on that whole scaling piece, all the systems and processes. So, excuse me. So every deal we did, we were using the same contractors, which was a lot easier back then when contractors didn't have a lot of opportunity. We were using the same materials in every flip. We're using the same flooring, the same cabinets, and the same countertops. And we were using the same light fixtures and the same plumbing fixtures, the same doorknobs, all the same door hinges. Basically, everything was the same. So we could order things in bulk. Our contractor never had to ask us, what's the layout for this house, or what's the plan for this house. Every house was going to be the same. We tried to buy houses that were pretty much the same vintage, built between 1988 and 1995. So they had the same problems. They had the same plumbing issues. They all were basically end of life on their roof. They were all basically end of life on their HVAC. So we knew we had to replace that in every house. So going in and estimating the rehab cost was actually a lot easier back then, because every rehab we were doing was essentially a mirror image of the previous one we had done. And so we got really good at scaling the business very quickly. Given the fact that we had very little competition, it also allowed us to stand out in the market. So we would basically, our agent would go and show a buyer one of our houses, and the buyer would be like, yeah, this is a great house. I love it. It's just not the right school district, or it's not the right neighborhood, or I don't like the way it's situated on the lot. And the agent can say, well, I've got 4 other houses that look exactly the same as this. If you want to go take a look at those. And you can't do that these days because there are just too many houses for sale. There's too many house flippers out there that you're competing with. But back then, really the market was pretty scarce when it came to competition. And so we could stand out, and we could really, we were able in the county where we were working, we had a brand. Agents knew who we were. They knew what our houses looked like. They knew that if they had a buyer 2 months from now, that whatever house we were working on would look pretty much the same as the house we worked on 2 months prior. It's funny. There were a bunch of houses that we didn't want to take the time or the spend the money to go in and take pictures. But we had enough pictures of other houses that were similar enough with the same materials, same layouts, that we could reuse pictures between our listings. I mean, it was that scalable for us. And so for a couple of years, things went really, really well.
That's awesome. Yeah. And you think, I've interviewed a lot of guys who and girls who've got their roots in tech. And there's one thing that is common among all the, I don't want to say executives, but people working in tech. The one thing they understand more than many other people, especially new entrepreneurs, is systems. Oh my God. It's because everything in tech is systematized, because usually you're telling a computer, which is a system, to do something, and you have to talk to the computer like it's a 2-year-old. Now with ChatGPT, it's like a 10-year-old, and it's a little scary, but like, point is, you have to tell it to do everything and build that system around everything that you're doing. So it's really interesting that you and your wife had that background, and then you simply adapted it to real estate, to a real estate business, which was flipping houses, and creating those efficiencies. I mean, that's really what any business is about. Like, you want to grow your business. So you want to have, your inventory coming out. In this example, your product is the house, right? Is the finished house. So you have your criteria, which, you talked about your vintage, and just for folks that don't know what that means, that's like the age of a property, right? They say the vintage. It's not like a wine, but I guess that's the same technology or terminology. But regardless, you have your exact vintage. You know what neighborhood you're looking for. Is it a 2-bedroom or 2-bed, 2-bath, 3-bed, whatever. They all have these kind of similar problems. And plus, because they have, they're at the end of the life on the roof. They're at the end of the life on the HVAC. You're able to negotiate way down on the price, and the people want to sell. And in that market, my suspicion was that people just saw doom and gloom, and they're like, man, I got to sell this thing. Ain't no one going to buy it the way it is. I got to sell it. I'm going to fire sale this thing, get out of it, and, whatever, move on with my life. So the opportunities were out there, really, really out there for house flippers and wholesalers and all of those folks. But keeping that up and going and creating the system around it, man, I mean, that is just genius. And I love the fact that it's like, we're buying our stuff in bulk. We're using the same contractors. Those are the steps. Like, that's how you create efficiencies within a business. And at the end of the day, those efficiencies reduce expenses, and your net operating income increases. And it's the same thing we talk about in multifamily, which we're going to jump into next, but it's kind of the same business model, right? You're pulling levers, you're finding efficiencies, you're responding to the market, and you're rewarded with an increase in net operating income, and usually an increased business valuation. And that's how you create wealth in real estate and wealth in America. I mean, it sounds simple, but it kind of is. And for some reason, so many people try to do everything themselves, and I don't.
And here's the crazy thing. A lot of people don't recognize that real estate is just like any other business. If I were to tell somebody, hey, you want to flip a house or start a real estate business, they'd be like, yeah, let's go. Let's give it a try. Let's jump in, and they'd know where to start. If I told somebody, hey, you want to go start a restaurant? They'd probably be like, whoa, that's a big undertaking. If I said, hey, let's go start a retail store selling shoes, a shoe store, they'd probably think, well, I don't know anything about starting a retail store. If I said, why don't you go start a car dealership? People would be like, what do I know about car dealerships? But for some reason with real estate, people feel like, oh, this is easy. I can just jump in. But the reality is real estate's a business just like any other one. And if you know how to run a business, it doesn't matter if it's real estate or selling shoes or selling cars or running a restaurant. When you understand what it means to manage supply chains and manage inventory and manage cash flows and manage people and deal with systems and processes and deal with sales and deal with marketing and deal with all the other things that are integral in any business. Once you learn the basics of all those things, you can plug in any business into any system. You can go and I'm confident that if I wanted to start a shoe store today, I could start a shoe store. Would I be good at it? Probably not, because it doesn't excite me. But I know that I could figure out the nuts and bolts of starting a shoe store, because it's really no different than the real estate business that I've run or any of the other businesses that I've run. And so what I encourage people to do is, instead of focusing on how to paint your house, Instead of focusing on how to stage your own house or market your own house or be your own contractor, even do your own acquisitions, focus on learning how a business is run. Focus on learning about how inventory works and supply chains work and accounting works, and learn how to read financial statements and how to create financial statements, and learn all of those things that are going to be common across all businesses. Because once you do that, it's going to be real easy to plug in real estate or shoes or food or cars or whatever that underlying inventory that you're buying and selling is to run that business. And so focus on being a business person, not a real estate person. When somebody asks me what I do, I'm an entrepreneur. I'm a business guy. My business is for the most part real estate, but that's not how I identify myself. I identify myself as a business guy who happens to be working in real estate. And so I can transfer those skills to any other business as well. And I think if more people took that attitude and really focused on those business skills, we'd have a lot more successful and happy people in the real estate industry.
Yeah, I couldn't agree more. I mean, I have a short-term rental business, an arbitrage business, and if listeners here, they've taken the Military Short-Term Rental Academy, they know all about this. I talk about it all the time. But my latest crusade, if you will, has been more automation. So I hired an assistant, hired some virtual assistants, and it's incredible. I mean, what I used to do, I used to be like having to order things and supplies and maintenance and all of this, and I've trained them. And now this morning I wake up and I have here's all the problems. Here's all the stuff you need to order. Here's all the problems. Oh, and here's I've created the cart. All you got to do is click the button to press go on the order. Everything's there. And here's the maintenance report for the week. Here's who's coming in. And so now my time, instead of doing those tasks, my time is looking at the financial statements, making sure that we're profitable, and tweaking pricing on the short-term rental units, like the important things that are literally going to drive the revenue, not like the minutia of the day-to-day. Like, you can outsource that, and understanding that and realizing in any business that it's not all on you. Even if you are a solopreneur, it doesn't have to be all on you. And leveraging other people is so important, so valuable, and I'm glad that you're able to do that. So kind of moving this conversation into multifamily, because at some point, and I want to hear this transition, you were flipping houses. At what point were you like, my efficient model might not
So
be
it wasn't so much that it wasn't sustainable. So we flipped somewhere between 400 and 450 houses between 2008 and 2016. And we could have kept going. But the reality was, after 8 years, I got burned out. House flipping is, I'm talking about systems and processes and scaling, but the irony there is that house flipping is actually a relatively difficult business to scale, simply because the acquisition piece is so difficult. We talk about all businesses being the same, and to a large extent that's true. The big difference is that for most businesses, the acquisition side, getting your inventory, is actually pretty easy. And the struggle is on the sales side, basically selling it, marketing and sales. And in real estate, when I started out, it was very much that way. 2008, 9, 10, 11, 12, even 2013, there was so many deals out there that our acquisition strategy was basically go on the MLS, close our eyes, point, and whatever we were pointing at was probably a deal that we could make. Yeah. The hard part was actually the selling. Like, we might have 5 houses that were renovated sitting on the market, and there literally might only be 2 buyers looking for houses in that market at that particular time. And this was a relatively big market. We were within like half of a county. But there were so few buyers out there that the selling was the difficult part. And if there were 2 buyers in a market, we wanted to make sure those 2 buyers were buying our houses, not somebody else's houses first. But if we had 5 houses sitting, there was zero chance we were going to sell everything. And so we really had to be creative on the sales side, just like most traditional businesses. By 2015 and 16, things got really, really tough on the acquisition side. There was a lot of competition coming in. We were doing direct mail. We were doing cold calling. We were doing even some bandit signs, just all these things that are prevalent these days. But back then, everybody was jumping back into flipping and everybody was doing that. And there was so much competition that we found that all the systems and processes we had in place actually weren't serving us well because our pipeline on the acquisition side was slowed so tremendously. We just couldn't find a lot of houses. Now, at that point, the obvious pivot is to go expand your farm area, to expand to other markets. And so in 2016, I had a tough decision to make. Do I want to scale the business geographically, find additional markets so that we could fill that pipeline and we could continue doing a lot of deals? Or did I just want to stop doing this? And I was really tired at that point. I wasn't looking forward to the next piece of the scaling function. And so I said, look, if my heart's not in it, I probably shouldn't be doing it. And so in 2016, I said, I'm taking a break. 2016, 2017. I said, I'm going to take a break. I'm going to take 6 months off. I think I was working on a book at the time. I said, I'm going to work on the book. I'm going to spend some time with my family. I'm going to decompress. I'm going to get over 450 flips, the stress that has come with the last 450 flips. And I'll figure out, just like we did in 2008, I'll figure out what's next. And so what I realized within a couple months as we started selling off all the inventory was we had a lot of cash. And all this cash had kind of been deployed for 8 years in our flips. But once we stopped flipping, exactly.
Kind of just like cyclical, right?
Exactly. And if I looked at my financial statements, I knew how much cash we had, but I never really saw it sitting in a bank account. I never had to question, what am I going to do with that cash? How am I going to deploy it? How am I going to earn with it? Because I just kept rolling it back into the flips. So 2016, 2017, we stopped flipping. All this cash comes back. And now I'm asking myself, what am I going to do with all this cash? And so the obvious answer at that point is invest it passively with somebody I trust. So there are these things out there called syndications where basically you're a passive investor. You turn over your money to somebody who you trust, who can put that money and pool that money with other people's funds and put it into a big deal. And so I started doing that. But what I found was I am a control freak. And I'm not somebody who can turn my money over to somebody else and sleep well at night. So that was really hard for me. And so a few months later, it hit me. I really liked this syndication model. I really like multifamily. I feel like multifamily, or I felt like multifamily at the time, and I still do, was a good asset class to be in. But I didn't want to be turning my money over to somebody else. So it quickly hit me. Maybe I should be doing multifamily investing myself. Maybe I should be doing these syndications myself. So that way I get kind of the best of both worlds. I can invest my money in my own deals alongside my other investors. So I now have a place to invest my money that I'm comfortable, but I can also be the person that's running the deals, operating the deals. So I'm comfortable with the operations side as well. And so in 2017, I decided, okay, my next step is going to be multifamily, but how do I do that? And at that point, I had taken money from private investors before, but generally they were friends. They were people I knew. Yeah, exactly. I had never gone out and raised large amounts of money from people I don't know. And when it comes to syndications, basically you're raising large amounts of money, mostly from people you don't know. I wasn't comfortable doing that unless I knew I had a really solid education. I really knew what I was doing. And so I started to reach out to some people I knew in the multifamily space. And I ended up reaching out to a woman I knew. Her name was Ashley Wilson. And we had been friends for a few years. She had been doing multifamily. I trusted her. I loved what her business was doing. She and I have a lot of the same kind of ethics and values and all those things. So I reached out to her and I said, look, I really want to get into multifamily. Let me propose something. How about if I come work for you for a year? You'll have access to me, my money, my time, my effort, my knowledge, my network, anything you want from me for 1 year. In return, all I ask is you kind of teach me the business. Let me kind of see behind the curtain on your business, be involved in a couple deals you're doing, and learn the business. She jumped at that opportunity. I obviously thought it was a great proposal. And so we worked together for the next year. This was 2019. We worked together for the next year. And after a year, what we realized was we had just a tremendous amount of complementary skills. All the stuff that she wasn't good at or hated doing was the stuff I did like to do and I was good at. All the stuff that I didn't like doing or I was really bad at, she was amazing at. And so we realized that between us, we were kind of like a super investor. And so 2020 rolls around and she says, hey, why don't we solidify this partnership? Why don't we kind of go into business together, and we start doing multifamily together? And so for the last 3 years, we've been business partners and growing our multifamily business.
Wow, that's awesome, man. Yeah, I love the pivot, and understanding your core values when you made that tough decisions. I've made similar tough decisions. And it's tough when you're an entrepreneur because it's really easy to get the good idea fairy tends to pop up a lot, and you're like, oh man, I really want to go and do that. That business looks so cool. Look at that guy on Facebook and Instagram; he's totally crushing it. And then you're like, can I do that? And then you're like, well, to some extent, it becomes like a zero-sum game, because if you go and do something else, you totally can. That's the joy of being an entrepreneur, is you have that freedom, right? But a lot of the times, another business may suffer unless you have it scaled to a point where you are physically handing the keys over to someone else, and they are they're doing the operations full time, and you are more of like a silent owner kind of a situation. If that's your situation, go for it. Then chase your dreams. But if you're not there yet and you want to step away from the helm, you could run into some problems. So I think you made the right decision there, Jay, when you said, you know what, this is not feeding my soul anymore. It's not sparking joy, as that whatever the cleaner said.
I know exactly who you're talking about. Yep.
On Netflix, flipping houses is not sparking joy anymore. And you said, okay, well, let's just slowly kind of shut it down and do something else. And you were successful at it, so you had the cash. And I love where you pivoted that. So, we've had a ton of people on this podcast talking about multifamily. So I think listeners are probably exhausted with the asset class of multifamily, but it is just so awesome. And, at ADPI Capital, it's the same thing that we're doing. We have so many people finding deals for us, and we're connecting the community with those deals. And it's really, really neat because the asset class is so strong. But what I want to talk about next in the last couple of minutes we have here is, what is going on with this economy, man? Like, so what is your perspective on where we are? And to give listeners, obviously it's a recorded podcast. We're recording this in April of 23. So we're about, what's it been, a month since SVB failed? Maybe 5-6 weeks. A couple bank failures going on. Tech is continuing to lay people off. And usually from everything that I've looked at, and you've been through this recession before, Jay, isn't this this sounds like the beginning of a recession? No?
So let me give you a very definitive, exactly what is going to happen over the next 6 to 12 months. I don't know. I have no idea. And if anybody tells you that they know what's going to happen, they have no idea either. Let's all think back 3 years to March of 2020, and COVID hits and the world gets shut down, and I'm sure everybody remembers, struggling to find toilet paper. Who would have thought that a year after that, 2 years after that we would see the greatest run up in asset values in history, that real estate would increase 30, 40% in some markets, that the stock market would basically go up 50% between April of 2020 and a year later. Who would have thought these things were going to happen? Nobody could have predicted that. And so, but everybody back then, including me, was certain that the world was coming to an end, that things were falling off a cliff, and we were all wrong. So the first thing I'll say is, as much as I might be confident, and as much as you and everybody out there listening might feel confident in where we're headed in the next 3, 6, 12, 24 months, and I'm happy to talk about what I think is going to happen, I always like to remind myself that 2020 happened, and everybody not only was wrong, was 180 degrees wrong. What happened was completely the opposite of what we expected. So no matter what I say and no matter what anybody might think right now, remember, things can change. And a lot of times the things that change are influenced by external factors like the Fed, by black swan events, by lots of things that happen out there. So yes, best laid plans. We can kind of guess at where things are headed. We can look at the data. We can use our best judgment. But at the end of the day, keep in mind, nobody really knows, and anything can happen. Now, with that said, once again, like I was in 2019 and then in the beginning of 2020, I'm fairly confident that we are heading into a recession. And again, just like 2019 and 2020, I'm guessing most people that are listening to this agree with me. A lot of people might think that we've been in a recession for the last 6 months or 12 months. I'm not going to argue with that. I think there's a lot of data that indicates. Yeah, here's the thing. We don't have a good definition of recession. And I know there are people that say, well, two negative quarters of GDP is a recession. Well, if that is the technical definition, if that's the definition that you want to go with, well, we've now had 2 and almost 3 quarters of positive GDP growth. So if that's your definition, then by that definition, we're no longer in a recession. But I don't like that definition because I think that there's a lot more nuance that we have to look at. So regardless of whether you think we're in a recession now or not, I'm fairly confident that over the next 3 months, 6 months, 12 months, things are going to get worse. We're going to see a lot of the same struggles that we've seen over the last year with supply chain issues and potentially some inflation issues, and all these other things we've seen. Plus, I think we're going to start to see some issues in the employment sector. I think we're going to start to see unemployment increase. I think we're going to start to see wage growth, which has been pretty stagnant in real terms. And when I say real terms, I mean wage growth relative to inflation. So wage growth has gone up about the same rate as inflation over the last couple of years, which means people aren't making more money. In some cases, we can say they're making less. I think that could get worse as well. I think we could see wage growth relative to inflation trend down even more, so people are making relatively even less money. I think things are going to get worse. So that's kind of my high-level prediction. Now, first question people ask then is, how bad is it going to get? We have no idea. Obviously, there are people out there that are saying this is going to be worse than 2008, that this is going to be, we're heading into the next depression. There are other people who say, it's going to be a blip in the road. In 6 months, the Fed's going to start lowering interest rates, and a year from now we'll be fine. It's possible one of those extremes is correct. But what I like to assume until we have better data is that what we're going to see is what we've seen historically most often. And here's the thing. Over the last 160 years, we've had 34 recessions in this country, maybe 35 if you want to count last summer. So 34, 35 recessions over the last 160 years. We can do the math. 160 divided by 35 is somewhere around 5 years, 4 to 5 years. Every 4 to 5 years in this country, we on average have a recession. Now, when I say that to a lot of people, especially younger people, they're like, that's crazy. What do you mean we have a recession every 4 to 5 years? They remember 2008, and they remember that 12 or 13 years between 2008 and 2020, or even that 15 years between 2008 and now, where there hasn't really been a recession. But historically, that's not the way things work. Historically, we have recessions every 4, 5, 6, 7 years. And so if you're under 30 or 35 years old, you probably don't remember the 2001 recession or the 1992 recession or the 1989 recession or 1982 or the 3 recessions between 1968 and 1978 or all the recessions before that. You don't remember those things because you didn't live them. But the reality is we experience recessions until this past 15-year span. We've experienced recessions every 5 or 6 years. And typically, despite what a lot of people believe, a recession in this country normally doesn't look like the 2008 event. But
no. Yeah, that was a forcing factor of just poor regulatory practice.
Yeah, and I think that's probably obvious to you. It's obvious to me. But I talk to a lot of people who are under 30 years old or even 35 years old. Their only memory of a recession as like an adult was 2008. And so their assumption is when they hear that word recession, They think of something much worse than what typically happens. And that makes sense because that's all they remember. But if you go back and you look at the historical record, in reality, most recessions are a lot more mild than 2008. We have unemployment that spikes up. We have some inflation that leads to the recession. Typically, the inflation comes before the recession. We have people losing their jobs. We have people defaulting on debt, people going into foreclosure, but nothing like 2008. There are people that are affected, but the economy in general isn't crushed. And so what I think people have to remember is if we're heading into a recession, while it could be a really bad one, the reality is, historically speaking, it's more likely to be, I don't want to say a bump in the road, because there are going to be people losing their jobs. There are going to be people losing their houses. There are going to be people that are going to have to go into bankruptcy. So it's not going to be fun, but it's not going to be a 2008. Sure. Most likely, it's not going to be a 2008 type event. And most likely, 12 to 24 months from now, we're going to be coming out the other side. So that's the other thing. We tend to have these economic cycles where we have recessions every 5, 6, 7 years. But historically, 75% of the time is spent in the good phase of the economic cycle and what we call the expansion. And it's only about 20 to 25% of the time that we spend in that recessionary phase, meaning we're only typically in a recession 1 to 2 years before we come out of it and we start the next expansion. So even if we are headed into a recession, and again, I think we are, I also think there's a good shot that a year or two from now, we could be coming out of it. Good shot that the Fed has lowered interest rates to kind of spur economic growth after the recession starts. And so I think 2 to 3 to 4 years from now, what we're going to see is that things are good again and the economy is expanding again and asset values are going up again. So if you're buying real estate today with the intent to hold for at least 3 or 4 or 5 years, what you're going to find is that you're probably just fine. And so even if a recession is coming, even if bad things are coming, it doesn't mean that we should stop buying real estate. It doesn't mean we should stop investing. It doesn't mean we should put our lives on hold. Just the opposite. We should be looking for a good opportunity to buy with the expectation that we're going to have a really good opportunity to sell in 3 or 5 or 7 years.
Yeah. Man, that breakdown was great for folks who want that. Just rewind the last, I don't know, 3 to 4 minutes and listen to Jay, because you're absolutely right. And I've been on some calls with people who are a lot smarter than me, wealth managers, family office managers, who have been through multiple recessions, and they do this. They say the same thing. It's like, hey, listen, we've seen this before, and it's not going to be like 2008. But yeah, I mean, people are going to start losing their jobs, and you can see if you've looked at the reports even today that have come out, the economic reports, and you're seeing just effects on just new home buying is down over 20%. We're seeing tech is doing massive layoffs, but for once, as of today in this recording in April of 23, we're seeing that the job market is finally beginning to show signs of loosening, because we've been at record low unemployment. So all the people who are losing jobs, they're going to get new jobs right away, but not anymore. And that's because the pressure that has been put on businesses from higher interest rates. It's so much more expensive to run your business. Well, guess what? I mean, people are, pretty expensive. So if you can't hire any more people, then you got to lean on automations and systems. And if you can't do any of that, then you got to start letting people go. And that is what I think is happening. So you're right, Jay. People are going to lose their jobs. It's going to suck for a lot of people. I mean, that is a fact. But from a real estate investor's perspective, when this happens, typically first-time home buyers, they can no longer buy the homes that they want to get into, right? So what do? Well, they have to rent longer than they were anticipating. That's okay. That means that rent is going to stay stable, and if not, maybe even go up. So if you're looking in the multifamily space, which both of us are, and many other listeners of this podcast are, then yeah, I mean, typical turnaround time on a commercial multifamily project, 5 to 7 years. That'll ride out a recession. You'll cash flow. You can add value, cash flow, and you're if everything goes well, your valuation, you run your business plan the way you want it to, your valuation on the way out is going to be great. And it's like, it's not the time to get scared and put your pencils down. now it's the time to finally, like when this tipping point of recession comes and we can see the effects on inflation, which you said correctly stated usually precedes a recessionary environment, then now's the time to start even looking harder and saying, hey, who bought wrong and how can I help them out of a jam before something real bad happens and they have to foreclose? And there's a lot of people in the multifamily space who bought wrong and were underwriting on 3 to 5% year over year rent growth. They took these bridge loans, and guess what? The loans come in due, and they got problems. So very, very, very
Here's
interesting
here's
concepts that
another
you
little
shared
secret
here,
with
Jay. I love it.
multifamily. It's not really a secret at all, but let's pretend it's a secret that we're telling. So we're building it up to something
It's our
big.
secret.
No, but here's the thing I like to remember with multifamily. So anybody that invests in commercial real estate knows that there are two things that impact values. The value of a commercial real estate asset is essentially defined by the income it generates and the cap rate of that type of asset in that market. So income and cap rate. And while we like to treat them equally, at the end of the day, cap rate is a lot more influential on prices, just because that formula is a lot more sensitive to cap rate than income. And so what we've seen over the last 5 years is, at least what I've seen in a lot of LP investments that I've made and deals that I've seen over the last 5 years, is that there have been a lot of deals that have done tremendously well. But they haven't necessarily done well because the operators have performed from an operations standpoint as they expected. They haven't necessarily raised rents as much as they thought. They haven't necessarily lowered expenses as much as they thought. In fact, in a lot of cases, what I'm seeing is that the deals I'm invested in other people's deals, they're not hitting their pro forma targets for cash flow, for P&L. But we've seen compression in cap rates over the last 5 years, and that compression in cap rates have driven values through the roof, and people have made a ton of money. So at the end of the day, income is really important, but cap rates and the direction of cap rates is even more important. So you have to ask yourself, we've seen an expansion in cap rates in most markets over the last 12 months of anywhere from a half point to 3/4 of a point, which has driven values down 20-25% in multifamily, at least in the markets we've seen. I like to ask myself the question, what are the chances that over the next 7 years, we don't see compression in cap rates again? We don't see cap rates go down again. Keep in mind, interest rates are almost certain to go down once we hit a recession. The Fed's not gonna let interest rates stay where they are. Exactly. So unless you believe that there's no shot of cap rates compressing over the next 7 years, you have to believe that there's a really good chance that values are going to go up again over the next 7 years. That at some point, cap rates are going to come down a 1/4 point or a half point or 3/4 point. And when that happens, that's going to override a situation where maybe rents aren't rising as quickly as we expected, or maybe insurance is going up faster than we expected. That cap rate compression is going to outweigh that income and expense, those income and expense projections that might be off. So I'm not saying go in expecting cap rate compression. We go in, we still expect that cap rates are going to expand every year. But we know in the back of our minds that if cap rates actually do compress, there's almost zero chance we don't make money. And we're fairly confident that sometime over the next 7 years, we're going to see cap rate compression again. So we're not really worried about any catastrophic events, assuming we can continue to run these deals profitably for the next 5 or 7 years, assuming we don't have to worry about refinance issues or rate cap issues or other debt type issues. Again, we're underwriting very conservatively, but we think there's a lot of upside that we don't even put on our underwriting, just given the fact that we think that cap rates at some point are going to compress again, and that's going to hopefully blow our projections, our pro forma out of the water.
Yeah, and that's really what investing at its core is about. Whatever you're investing in stocks, you're investing in equities, you're investing in real estate. It's risk mitigation. it's it's understanding the business that you're in, understanding the asset class that you're in, understanding the levers that you can pull to mitigate the most risk and stay on target on your business plan. And cap rate is mostly out of
Yep.
individual investors' control. I mean, it's market driven, right? It just it is what it is. And so if you're looking and you're buying a deal right now and you're forecasting some cap rate expansion, which remember means that your value of your property is going to go down, assuming everything else stays standard, stays status quo, then that's fine, as long as what Jay's saying is if you believe that the cap rate will then compress, again, and you'll make money. So the real key in that business model, given the market environment that we're in, where Jay, you said that in a lot of markets you're looking and you've seen 500 basis points, 750 basis point cap rate expansion, right? So then the onus is on the operator to say, okay, I got to be laser focused on my numbers, on my income projections, and on implementing this business plan and staying, and making sure that this thing cash flows, because during this period of cap rate expansion, I need to mitigate that risk of something that I cannot control by creating income in the business, and that's through rent and all of that stuff that
Yep.
multifamily investors understand, right? By supporting that net operating income
Absolutely.
that you need to hit your numbers, pretty much, right? But then on the back end, when that cap rate compresses and you're still running your business the way you want to run it, that's where you make even more money. So there's a lot of levers to pull. So at the end, like putting a pin in this, it's don't feel like you have to put your pencils
Yep.
down and run away because interest rates are up. And this goes for any investing. There are deals out there. You just need to come up with your criteria, and you need to go and farm it out to your deal providers and sharpen your pencils and just start taking a look and start practicing and underwriting the deals that are out there, because they're just there. And it's easy to just say, oh, I'm just going to wait, Jay. I'm going to wait until it's better. I'm going to wait till the economy's a little bit better to get involved. Then you're too late. You're not an investor. You're not an investor then.
Yep.
I mean, hell, you're not even a speculator. You're kind of just a loser. So, I mean, so don't do that.
Don't buy high and
But,
sell low.
dude, this has been awesome. Yeah, exactly. Yeah, do the opposite, please. Buy low,
Yep.
sell high. What's that, like Warren Buffett's number one thing? Yeah, it's like step 2, see step 1. One of those situations. But Jay, this has been awesome. And I'm going to mention real quickly before we get into the bonus round. Actually, you know what? We're running long. Screw the bonus round. I'm just going to go into this. Jay, you will be down with us at ADP Icon. Yes. So ADP Icon, guys, if you haven't heard of ADP Icon before, this is our second convention. We do
October
it once a year.
27th to
It's the end of
29th.
October. It's October 27th to the 29th. Yep. 27th to the 29th. Jay will be a keynote speaker down there, and we're going to be talking a lot. And honestly, I'm really excited because it's April now. And by October, we're going to have a whole different economy and probably a whole different talking point and everything to talk about. But man, it's going to be awesome. We locked up the Westin on the Riverwalk in San Antonio. So if you've ever been to Lackland Air Force Base or any of the other 4 military bases in San Antonio, you're probably familiar with the Riverwalk. And we have an incredible guest lineup. Hal Elrod is also speaking, wrote The Miracle Morning. He's been on the podcast. I don't remember what episode, but that was a legendary
It's
podcast.
worth it just to hear
and
Hal Elrod speak. I've heard him speak a couple times. He is always amazing.
Good. Yeah, like worth the price of admission. And speaking of which, we have sold out already all of our early bird tickets. So if you thought you were an early bird, you weren't early enough. But we still have a lot of general admission. We still have a lot of VIP and platinum. So just check out adpicon.com, www.adpicon.com, and go and get your ticket. Get your ticket for your spouse, your partner. Bring them along, because when you leave ADP Icon, just like everyone left New Orleans last year, you leave with an action plan that you can implement and begin real estate investing. And with the market going the way it's going, there has never been a better time to educate yourself in this stuff, guys. I mean, this could be this could be life changing. It changed my life, changed Jay's life. You know, it's out there. So
absolutely, I'm excited. I'm looking forward to it.
Yeah, it's going to be an absolute blast. All right, y'all. For Jay, for folks who want to get in touch with you and learn more about what you're doing,
www.connectwithjayscott.com. That'll link you out to everywhere you might want to go.
Yeah, and guys, remember it's the letter J, not Jay.
Yeah, I
J,
have
Scott.
both URLs because I know a lot of people get that wrong.
Oh, there you go. All right. Yeah, there you go. You bought both domains. All right, never mind. Guys, read Jay's books. Go to his website. Connect with Jay. Connect with every single guest that's on this podcast, because you never know where that connection might take you. That is why you're listening to this podcast, I hope, to build connections, build your education, and jump into the real estate game and become a military real estate investor. So until next time, y'all, Jay, I had an absolute blast, and I will be counting down the days.
I'm looking forward to it. Everybody come out and visit us.
Super excited.